Penny stocks are a form of a public company with a low price but high risk. They entice highly speculative traders by promising fast exponential growth and the opportunity to double, triple, or quadruple their income. Don't be fooled. Penny stocks are extremely dangerous with a high chance of fraud and failure. According to Josh Simpson, a financial advisor with Lake Advisory Group, penny stocks are listed by the SEC as stocks that sell for less than $5 per share. Trading on the New York Stock Exchange or NASDAQ Stock Exchange can be done using the bulletin board or Pink Sheet's electronic quotation systems. Penny stocks are the type of equities that are traded. These stocks sell for less than $5 per share. The Securities and Exchange Commission provides a comprehensive overview of penny stocks. The advantages and disadvantages of penny stocks are hotly debated. Let's face it, we've all heard investment success stories about rags to riches. These tales are almost always the product of a penny stock sale. While we've all seen Wolf of Wall Street, none of us can be Jordan Belfort. However, there are some advantages to penny stocks if you are willing to take a significant amount of risk. These days, there seems to be two types of websites on the internet. Those who preach penny stocks and show videos of traders strutting around their million-dollar mansions, as well as those who treat penny stocks like the bubonic plague. Isn't there supposed to be a happy medium? In this post, I'll weigh the benefits and drawbacks of investing in penny stocks so you can make an informed decision. Penny stocks, Jekyll and Hyde. Are penny stocks dangerous, bad investments full of ruined investments and con artists driving flashy cars? Yes is the answer. Are penny stocks small businesses that are just getting started, or have they been ignored or undervalued by investors and can quickly multiply a small investment? The response is yes once more. You've also heard stories of elderly widows being defrauded of their retirement funds. Perhaps you met somebody, possibly you, who bought a risky investment because the story was convincing, but now the shares are worthless. Movies like The Wolf of Wall Street and Boiler Room send out the wrong message, almost encouraging an exciting lifestyle of profits at the expense of others. More aptly, this is simply called lying and stealing. Every story, however, has two sides. You've almost definitely heard of a penny stock that's now worth more than $10 per share. After all, many of America's great businesses began small and their founders usually became wealthy. Perhaps it was the stories or fast riches that piqued your interest, or perhaps it was the images of flashy cars and mansions that drew your attention. Despite the dangers, the prospect of rewards appears to be enough to entice tens of millions of optimistic investors to these low-cost stocks, for better or for worse. However, it is important to understand the advantages and disadvantages of penny stocks. The pros of penny stocks. The big winners of tomorrow. There are a lot of great businesses that trade for pennies. They have proven management teams, strong financial positions, rising market share, improving financial ratios, and innovative goods or services poised to take over an industry, turning small investments into much more. The majority of penny stock investors begin trading with small amounts of money. If an individual only has $500 to trade, they can only be able to buy 3 or 4 shares of a larger company, but they may buy thousands of shares of penny stocks. The excitement. Anyone who has made 5% on an investment in a year understands the adrenaline rush that comes with major gains and losses in penny stocks. The speed. Not all penny stocks see quick movement in their market price, but the ones which do can typically make their big price moves within days, not years. The cons of penny stocks. Low quality companies. The majority of penny stock firms are of poor quality. This is due to the fact that their financial situation is a train wreck, their balance sheet is terrifying, and their operations are losing a lot of money. Alternatively, they may have a dubious commodity in a dying market with many rivals. Most investors lose money. Unfortunately, the vast majority of investors who try their hand at penny stock investing end up with less capital than they started with. Risky markets. The New York Stock Exchange, the American Stock Exchange, and the NASDAQ, including their lower-level bulletin board market, all have listing criteria, reporting requirements, and investor contact responsibilities, so certain penny stocks trade on these exchanges. The majority of low-priced stocks, on the other hand, are traded on the pink sheets, OTC or OTCQX, where listing fees, standards, and reporting regulations are virtually non-existent. Thousands of lower quality firms flock to these lower caliber marketplaces, which aren't even stock exchanges. Shocking valuations. Any penny stock that is in the public eye, listed in the media, or circulating around the rumor mill has seen insane valuations. Since penny stocks do not need a large amount of purchasing to drive their prices up, any investor stampede will drive the shares to unsustainable levels. Bitcoin, marijuana penny stocks, .com stocks, and even Dutch tulip bulbs have all seen this. Tesla recently purchased a business, but investors mistakenly piled into a similar sounding penny stock, pushing the value of the worthless shares 10,000% higher before the penny stock crashed. Lies, scams, and pump and dumps. Penny stocks are ideal for defrauding investors because of their low prices and limited trading volume. In the worst pump and dump schemes, the promoter buys the stock at fractions of a cent, then puts lipstick on a pig by making blatantly misleading claims at best or outright lies at worst to the investor group. Their glossy mailer appears to be genuine, their website appears to be sophisticated, and the story they're telling you makes sense. Then they sell while their victims buy, driving up the price. The promoter profits while everyone who purchased tickets lose. Volatility. When price moves quickly and significantly in your favor, it's awesome, but there are two sides to the volatility coin. Just a small change in the stock price can reflect a big percentage gain, says Tyler Hart, Chartered Financial Advisor or CFA at Pelican Bay Capital Management. A jump from 50 cents to $1 per share does not seem to be much at first glance, but it is a 100% increase. On the other hand, when things go wrong, they go wrong quickly. A small absolute loss will equate to a large percentage loss. Most investors are unable to withstand such high levels of volatility. Thinly traded. Unlike larger firms, which can trade tens of millions of shares every day, certain penny stocks are extremely undervalued. Many people see a few thousand shares traded on a regular basis, while others may see even fewer. Should you invest in penny stocks? It's likely that the majority of investors have dabbled in penny stocks or at least considered doing so. If you're thinking of investing in penny stocks, make sure you're doing so as part of a broader investment plan that isn't solely dependent on the success of penny stock investing. You should be completely aware of the possibility of losing money in the hopes of hitting the big league home run. There's also a good chance you'll lose your entire investment. It can happen if you pick too many bad businesses, but it can't be stressed enough. Never put money into penny stocks that you can't afford to lose. If the majority of your portfolio is invested in more conventional and predictable properties, it's best to do it with play capital. Finally, if you're thinking about investing in penny stocks, start with paper trading. The TD Ameritrade service allows you to paper trade for free. Real money can only be invested if you can demonstrate a clear trend of choosing enough winners to make it profitable. If that pattern never appears, you can stop working on it without losing any money. How to buy penny stocks. Even after knowing all of the risk, if you're dead set on buying penny stocks, here's how to position yourself for maximum profits and limited losses. Decide how much you can lose. Penny stocks are extremely volatile and they're often mentioned in the same breath as cryptocurrencies. Set aside some money and don't bring any of your savings into these risky investments. Stick to major exchanges. On the major exchanges like the New York Stock Exchange or NASDAQ, there are plenty of stocks that trade for between $1 and $5 per share, Hart says. This dramatically reduces the chances of unwittingly falling victim to a scam. The liquidity available on these major exchanges is also much superior to those available on the OTC market. Furthermore, rather than using OTC tools, you'll most likely be able to buy shares through a conventional brokerage, making trading even simpler. Do your research. Although accurate information on many penny stocks may be difficult to come by, companies listed on major exchanges that have recently dropped below the $5 mark are a good place to start. Hart refers to these as fallen angels. They could be in markets that are suffering cyclical downturns, or they could be successful businesses that have hit a rough patch. Be conservative with fees. If you want to invest in penny stocks, search for websites that don't charge you a lot of money in fees and commissions. Since penny stocks are so cheap, you don't want to pay more in fees than you can easily recoup from your investment. Penny stocks are risky, and most over-the-counter stocks don't have a lot of details available. There's no reason to see penny stocks as a wise investment when there are so many alternatives that enable investors to start investing with $5 or less and still enjoy solid historical returns. Remember Simpson's parting words if you're still not persuaded. If you're thinking of investing in penny stocks, you'd be better off taking the money to the casino and having a good time when losing it, he advises. Invest more wisely. There are low-cost alternatives to penny stocks that allow you to begin investing without spending a lot of money. Although index funds or ETFs cannot double your money immediately, they should do so every 7 years based on historical returns, and you should see steady, stable returns long before then.